Hey, good morning, everyone. Marty Mazzora here, Thursday, the 27th of January, 2022. As I do a little bit of technical work on the market this morning, I thought I'd just pull up the charts and have you watch me do it, so to speak, and essentially see what this setup looks like right now, because we've obviously had quite the action so far this year. But what it looks like from a technical perspective. So I want to look at the S&P 500. I want to dig a little deeper into volume this morning, and then we'll take a quick look at the dollar as well. I will keep it quick. So in front of you is that one-year daily chart. And folks who've been watching these for the last few years know what wedge patterns mean. When you have a rising wedge pattern, it tends to be a bearish pattern. When you have a falling wedge, it tends to be bullish, particularly when the momentum indicators give you some confirmation. I'll show that in a second. Well, folks, this big drop-off that we've had here these past, several days, this doesn't really give us, I can tell right now, this does not give us a rising wedge, or I'm sorry, a falling wedge, which is bullish. In fact, if it really widened out, it'd be what's called a megaphone pattern, actually. Now, if this keeps up, so you see we have this big decline right here, right? If this were to continue now for another day or so, you'd actually have what would be termed a bearish flag pattern. Now, I've shown you in commodities for much of last year bullish flags, right, and how they worked, and they were just like clockwork. It worked really well for copper. They worked really well across the Bloomberg Commodity Index. And the way they work is you have a flag, and again, this is a bullish flag here, where you have this pattern, where you have this big breakout move, and then you have this consolidation that kind of moves against the trend for a period of time. And then when you break out, you tend to capture the next move, or at least a technician will set a price target, the length of the flagpole. Okay, so you could argue that we've got one forming here on the daily chart that looks pretty classic, actually. And where are we finding resistance? Right against that 200-day moving average. Now, we broke down below that with momentum, right? Now, we've tested it, kind of almost tested it here, but did test it here yesterday, testing it right now today. And we may come back and recapture it. In fact, just dipping below the 200-day moving average, the few times that's happened the last few years has been, a nice buying opportunity. So maybe that's the case now. This rolling over here of the 50-day moving average, though, is somewhat of a bearish look as well. So when we just eyeball the daily chart, it's concerning. Now, I know we get these violent rallies. As I look, the Dow's up like 420 points right now. It's been all over the place. We've had monster moves. I did mention in this morning's written blog that we don't get bound up in making short-term predictions. Okay. Now, having said that, I did add an asterisk this morning, and I said, month end, we could actually see a nice pop in stocks, because stocks have been a real mess. The S&P as of this morning, I think, is down 9% on the year, right about there. And the NASDAQ, as of yesterday, was down about 16% on the year. I also showed him that takes us back 6 months on the S&P and a full year on the NASDAQ Composite Index. And that's why I titled it Risk Happens Fast. So anyway, again, nothing, conclusive here. This could be a huge buying opportunity, a big buy the dip, which obviously there's some attempt to do that right here. When we look at, those momentum indicators that I always show you, really, you just have a continual rolling over, a little bit of life here, as we've gotten this bounce. Oversold, okay, so we're below 30 on the RSI. That's an oversold indicator for a short-term investor, so that would bring in buyers right here, just technically. And so we're getting that right. We're seeing that again this morning. But you don't have anything that remotely looks like positive divergences just yet. You could argue that one's forming here, and if this breaks through there, then we will have a strong, positive signal there. This is the daily volume, and this is the 10-day exponential moving average of the daily volume. I draw these circles here when we start hitting this threshold. And what you don't want to see if you're a bull is you don't want to see falling volume, right, when the market's rising. That shows lack of conviction. And you certainly don't want to see rising volume, right, when the market's falling. That shows conviction, right? Conviction on the part of the bears versus the bulls. Now, there's another classic indicator that we used to use quite a bit, and we'll still look at it. It's still loaded up on here. It's called on balance volume. And what it does is it just captures the accumulated volume on down days and up days. And so what happens is, like right here, this on balance volume was actually giving a pretty good looking signal here, meaning there was a lot of volume and the market was going up. But look what's happened since, around November of last year. We actually hit a new high. But my oh my, the volume was substantial on the down days. That's why this line is descending lower. Now, strategists would call that distribution. What it says is clearly money is exiting this market on the rallies, right? You get an up day, and then boom, you get it sold. Update, boom, you get it sold. Update, boom, you get it sold. Again, this is just the action that's been going on lately. Maybe there'll be some new news. GDP rose a little better than expected last quarter. That was out today. Although I would argue that really just fuels the fire, potentially for the Fed, right? Maybe they can fight inflation without killing the economy, right? And the market's sending mixed signals, across different asset classes there. So yeah, really suspect look right here for equities. Now, as for the dollar, here's the 1-year daily chart. And we had kind of a bullish, wedge look falling, right? And sure enough, we've broken out of that and we've broken above this level right here. So that's a strong, strong move for the dollar. So what's interesting is, folks, the dollar is believing the Fed. So this would be the currency rising based on rising interest rates in the US. And boy, it's playing havoc with our commodity positions today. It's playing havoc with our international positions, as you might imagine. Asia was a mess overnight anyway. Now, I will tell you, though, folks, that for a lot of the night last night, Dow futures were down over 400 points, and the NASDAQ was down like 2.5%. And so there's been some buying coming in today. Is it that portfolio rebalancing? I don't know. I noticed Russia is up a bunch this morning as well. And I haven't seen any news headlines, but I haven't got to the part of the morning where I really dig into the global news. There's obviously news that's pushing the dollar up. And we have definitely a falling dollar thesis over the next several years, and that plays into our current allocation. Obviously, that's not working today. But again, my point here is that the currency, the dollar, is believing that the Fed is absolutely going to be hiking rates. The stock market, at least at the moment as I talk to you, is acting like everything's great and the Fed is not going to get aggressive when it comes to inflation. So that's not what they've said. So we'll see how it goes. But this is a strong move for the dollar. And that's going to play havoc to some degree with our overall bias. Our long-term thesis says that the dollar is going to be weaker, given, for example, the debt setup in the U.S. and U.S. denominated debt the world over, and all these things that I've written so much about. So we think that's a pretty solid thesis. We absolutely expect days, weeks, months like this too. Right now, just a lot of portfolio rebalancing, repositioning, and so forth going on, I think. And people trying to figure out where they are, and a lot of people still trading the old regime relative to general conditions, and that's not the regime we live in today. But you'd think so based on some of the price action, at least on the up days. And I'm sure still a lot of professional money is scared to death that that there's going to be another big ramp up, and they have to play in this party, until somebody pulls a fire alarm. There's that stage 6, that boom bust sequence, where I say people continue to play the game even though they don't believe in it. Well, we'll see. That on balance volume that I just showed you in our own volume indicator suggests that we're in distribution phases, but this market can fool you, and you might get some short-term signals that turn out to be wrong. So we'll stay on top of it, and I'll keep communicating with you. Tomorrow or Saturday, you'll get the macro update. Then I'm actually away for a few days. I'll be back officially on Thursday, but I will be where I can get a signal. So, think this is a crazy market, so I may want to pop in with some commentary if I think I need to maybe give you some clarity on at least my view of what's going on out there. Folks, thank you as always for watching and listening. Hope you have a wonderful day. Take care.